Hi, and welcome to Chapter 19. Today we're going to be talking about options. And options are part of a class of family of investments called derivative securities. And we say derivative because their overall value is derived from another asset. So options can be placed on many different types of assets, bonds, stocks, commodities. But by and large, in this chapter, we're going to talk mostly about options on stocks. So the option contracts derive their asset value from the stock itself, but they're not stock. They have a derived value. That's why they belong to derivatives class of securities. And now derivatives as a class of securities have been responsible for some really horrific losses when, and more specifically, not so much options, but generally future contracts. And there have been occasions where companies have lost billions of dollars. Big banks and big hedge funds have lost billions of dollars trading derivative securities. And again, not really options, mostly future contracts. Now, these losses have scared a lot of investors away from using derivatives, but they are a good opportunity to take on some additional leverage in your portfolio or hedge positions in your portfolio. So it gives you a little bit more flexibility in ways that you can manipulate your portfolio to enhance your returns. Now, options are simply an agreement to transfer ownership from an underlying security at a specific date and time and price from one investor to another investor. So an investment contract is going to derive the value from another asset, and it can be used to enhance portfolio risk or reduce portfolio risk, or simply to generate income. So options can be viewed as an investment tool that offers investors many different types of opportunities, and specifically leveraged opportunities they can't normally get with stock without committing huge amounts of cash into the investment. So in this chapter, you're going to be learning about options and the different forms of options, and some, we can talk about some investment strategies with options to help manage your portfolio. Now, typically, you can't engage in option trading in a retirement account, but you can do that in a brokerage account, specifically a brokerage account where you're certified to trade options, and even at a higher level, certified to write the contracts themselves. So let's get into it here. So this is, go to the next slide here. So derivative securities are basically contracts between buyers and sellers. So it's an agreement of a transfer of ownership under specific conditions. And we'll get into the stock specific conditions in a little bit. So this is going to give investors flexibility in managing the risk of their portfolios because they can they could use option contracts to hedge their positions. So that way, if they're afraid of the stock price increasing or declining, they can get an appropriate option contract to hedge that risk. Now, of course, these option contracts can also be used for speculation, which, because of the leveraging nature of the option contracts, can lead to huge amount of profits with a minimal amount of exposure. Now, let's talk more about the transaction costs, the liquidity. So they are going to be different than stocks as far as the transaction costs, the liquidity, some of the underlying dynamics of how the options are traded. But most of the value in the option is going to come directly from the asset of the underlying security. Now, let's go to the next slide here. Okay. So why options markets? So derivative securities, which we talked about before, derive their value from another asset. And like I said, these derivative securities don't have to be exclusively on stocks. They can be on bonds. They can be on commodities. They could be on, pork bellies or wheat, oil, orange juice futures. So there's a large class of assets that can be covered under derivatives. So options are specifically what we're going to talk about in this chapter, and they're created by investors, not by companies. So investors create them and sell them to other investors. And this is done through the options exchange or options market. So if I want to write an option contract, I'm going to originate an option contract and sell it to another investor. Of course, I have to go through a broker who has to go through an exchange, and they all get a piece of the pie. But by and large, the companies have nothing to do with the creation of stock options. Now, don't get confused. There are stock options that companies create to give to their executives. That's not what we're talking about here. That's an extreme minority of options, and those are specifically tied to a company. What we're talking about here is options traded freely in the options exchanges, which are created by investors. So an investor creates call contracts or put contracts. That's called writing a contract. And then other investors have opportunity to buy these contracts if they feel that there's a market and they want them. So this gives the ability for an individual investor to create some additional income when they write contracts because they'll earn premium. And for other investors, it gives them the opportunity to invest with option contracts, which can help limit their exposure to the market while increasing their, when I say limit their exposures, I meant limit their losses, but actually increase the amount or size of investment through the leverage of options. So we will call these options indirect claims. So you don't have, the claim on the actual stock, but it's written in the contract in a particular way that, at the end of the day, these option contracts what they've done for finance is they've expanded the investment opportunities for different investors. They reduce costs, they increase leverage, and they increase efficiency. So we're going to talk more about that as this chapter rolls on. So let's talk about some basic terminology. So we have a put or a call contract. So let's start with a call contract. A call contract gives the buyer the right to purchase stock at a fixed price for a certain amount of time. So I could buy a call option to buy a stock at $30 a share for the next 20 days. And if that stock goes from $15 to $25, I have now the right to buy that stock at $20 per share, and I can sell in the open market at $25 per share. But it's a limited time horizon, so there's the specific dates. Now, a put contract is the right to sell a stock at a fixed price for a certain point of time. So put contracts are what you want to buy if you feel stock prices are going down, and call contracts are what you want to buy if you feel prices are moving higher. So the exercise, sometimes known as the strike price, so we can call it exercise price or strike price. This is the price that your contract is saying you're able to buy or sell the stock at. So it's written in the contract, and the exercise price doesn't change. The expiration date doesn't change either. So it's the last date which the option can be exercised or traded. So an option premium, or sometimes we call the option price, this is what changes. So this is paid by the buyer to the seller, and you're basically purchasing the contract. Now, these contracts will change in value as the underlying asset prices change. So call contracts will become the premium for those, the price of the call contracts will become much higher as stock prices rise. And as stock prices decline, the put contracts will become more expensive. And also, if underlying stock becomes more volatile, the premium can also increase in that way as well. Now, there are two types of option contracts that we're going to be talking primarily about American contracts. So the American contracts are better because they can be exercised at any time before or on the expiration date. So you have the most flexibility with the American options, and they can be any time during the life of the contract they can be traded. Now, European options are less flexible, so they can only be traded at the expiration date. So there's only one date you can exercise those contracts when they expire. Now, most options, of course, because of the flexibility, are American options. So that includes all options on stock equities. Now, examples of European options include S&P 500 index options and the 13-week Treasury bill options and foreign currency options. These can be a European style where there. And for a lot of these types of options, foreign currency, treasury bills, even index options, if you're looking to hedge your positions for a specific period of time, then the European options could be something you could utilize. But most of what you'll deal with in the stock market are American style options. Okay, so how options work. So if you're the call buyer, right? So you're going to buy a call option or buy a call contract on the stock. You expect the price of the stock to increase. So if you're a buyer, you want the stock price to increase. So if you buy a call option and the stock price increases, you will make money. However, on the other side, if you're a seller, if you're going to what we call a writer, so sometimes they're called sellers, but that can be confusing because if you buy a call contract, you can sell a call contract, the same contract. But writing is a little bit more clear. So sometimes when the book calls a seller of a contract, they really mean a writer. So if you're writing a contract, you expect, you're hoping that the stock price stays the same or decreases, because then you make money if the contract isn't executed. So your bet is that the stock price is not going to change or the stock price is going to go down when you write a call contract. And you write a call contract to earn the premium. So if you write a contract, you earn $5 a premium, and the contract expires, you keep that premium and can write a contract again. On the other side, a put buyer is like a short seller. So the put buyer is expecting the price of the stock to go down to make money. But if you're a put writer, which here they call a seller, you're hoping that the stock price, underlying stock price, increases or stays steady, and that will generate the maximum amount of return for you, which is the premium. So as a contract writer, either you're writing the call contracts or writing the put contracts, which means you're originating the contract to sell to another investor. You're hoping to make and keep the premium. And the way you could lose the premium is if the stock price moves in the direction. So for a call contract, if the stock price moves up, you're going to lose money. And for a put contract, if the price moves down, as a writer, you're going to lose money. But the opposite, inverse, is true if you're a buyer. Now, options, they have a limited time horizon, so they can expire and become worthless. So that's why if you write a contract and it expires, that's great. Your obligations are gone and you get to keep the premium. But contracts can also be exercised or sold. So if you buy a contract, you have the right, when they say exercise, that means that you can say, I want the stock, I want to buy the stock at a strike price, or they can be sold. You can sell your contract to somebody else who will pay you what the going premium is. Okay. So options exchanges are continuous primary and secondary markets. So they provide investor liquidity. So a long time ago, they figured out if we standardize the option contracts, so we have a standardized dates, standardized exercise prices, then the contract can be more easily traded between investors. So the options exchanges standardized the contracts, and they created the Options Clearing Corporation, which helps to prevent any confusion between buyers and sellers. So really the options market is what is going to be the connecting force between connecting the contracts of buying and selling. Now, so how it basically works is you would put the order in through your broker, who's going to get a commission. Then the broker would file the order, bring it to the exchange to be sold. So you basically have to go through your broker, and then your broker has to go through the options trading exchange. So an options writer can buy an exact option to cancel their position. So if I write a contract, that contract, I can't revoke or cancel that contract. The only thing I can do is, so if I write a call contract at a strike price of $50 a share, if I want to nullify that, then I would just buy a contract for the option at $50 per share, and basically that would nullify my position. Okay, so let's look at this payoff diagram with an exercise price of $25 per share. So we're saying, let's look at the buyer. Okay, So this is the profit per option. So we're going, so the stock price expiration is, we're saying is going to be $25. So what we're looking at is 25, 27, and 29. So the buyer of a contract, if the stock price remains at 25, they're going to lose the premium. But, well, actually, as the stock price moves higher, they're going to make the difference between the exercise price and the current stock price. So if the stock price moves from 25 to 29 and you bought a call contract, you're going to make $4 per share. Now, if you're a seller of a contract, I'm going to lose that $4 per share, because if the stock price goes up to 29, the buyer of the contract will exercise and I'll have to sell it to them at 25, which means I'm going to have to buy it at 29 to give it to them at 25, and I lose the $4 per share. So the payoff is not the same as the net profit, because the payoff is just looking at the change in strike price to stock price. The net profit, you have to also factor in the premium that you paid or lost and the commissions. Okay. So in this diagram, we're going to look at exercise price at 27. So, oops, wrong one, hit the wrong button. So a buyer of a contract, if the so if you're buying, and this is for a put contract. So if you're buying a contract and the exercise price is at 27, then the stock if the actual stock price goes down, you're going to make money as a buyer of a put contract. But if the stock price goes up, the seller would make the money on the contract. So again, if the put contract, you're hoping that the buyer's hoping the stock price goes down, but the seller's hoping that the stock price stays the same or goes up, so as not have to pay. And that's a zero-sum game. So whatever the seller loses, the buyer gets. So here at 23, which must be the exercise price, the buyer and seller, no one's making any money. So the contract must be written at 23. So at 23, no one's making any money. And this is excluding premiums and commissions. So if the stock price changes, it goes 23 to 27, the seller is going to make the money here, because the buyer can't execute the put contract because the prices went up. But if the prices go down, then the buyer can exercise the put contract and make some money. Okay, so let's see, a covered call, where a covered call basically means that you own the shares of stock first. So you have the shares of stock in your account, and then you write a call contract. So you have the shares to deliver on the call contract already in your account, so you're covered, as opposed to a naked call where you don't have the stock. So in the chart here, if we look at this diagram, and again, when we have a covered call, it can limit our losses, because if the stock price goes, say, if you write a call contract without owning the stock, and for a strike price of 25, and the stock price goes to 2,000, you're going to have to buy that stock at 2,000 to deliver to the person who purchased your contract. Now, if you actually have the shares in your account, then the stock price goes to 2,000, you're not going to lose any money, because you're just going to hand over your stock to the person who bought the contract. So you wouldn't be in a loss position, because you're already covered. But if the stock price falls, you'll only get to keep the premium on the option, but you're going to be holding a stock that lost a great deal of money if you wrote a covered call. So there's benefits and drawbacks to writing a covered call. One benefit is you limit the potential for unlimited losses if the stock price goes up to a higher and higher position. Now, protective put contract is sort of like you own the stock, but you want to purchase a put in case the stock price goes down. So this way, if the stock price doesn't go down, you just lose the premium on the put contract, but you still have your stock intact. But if the stock price does go down, the put contract will make up for the losses of you holding the stock in your account. So say, for example, when would you use this protective put? Well, you might use this in a situation where you own a stock, it's a pharmaceutical stock, and tomorrow we're going to find out whether or not their cure for hair loss is going to be approved or rejected by the FDA. So this way you have a stock, it's currently valued at $100 per share. This is their only drug. If this does not get approved, this stock's going to zero. Now, if this drug does get approved, the stock's going to 2,000. So if you put a protective put on your position, this way it's going to cost the premium will be a fraction of what it would cost to have a position in the stock. So if the stock price goes to zero, the protective put will recover probably 95% of your losses. And that's one good thing to have. So that way you can hold the stock and the protective put will protect you from the losses. Now, if the stock goes up to 2,000 because the cure is approved and it's effective, then you could just let the protective put expire, just lose your money on the premium, and you can still own the stock and sell it at 2,000. Okay, so in that respect, if you have a portfolio, and sometimes hedge fund managers will have these large portfolios, and you can use a hedging strategy to minimize your losses and keep your potential upside. So buying protective puts, say you feel like the market's going to go down 30%. So you can buy, say you have all your money in the S&P 500 index. You can buy a protective put on the S&P 500 index. So if the S&P 500 is at 2,500, you can buy a protective put for minimal cost at a 2,400 level point. And if the S&P 500 goes down to 1,500, you'll be able to use the protective put to recoup your losses between 2,400 and 1,500. So basically, the value at the end of the period is greater than the exercise price of the put. Now, generally, it's not always possible to find puts or calls that exactly match your portfolio. That's why I use that index of S&P 500 index example, because you could use this as a way to easily hedge your position, because there are plenty of puts or calls on the S&P 500 indexes, where if you had a portfolio of 30 different stocks, it might be a little bit more troublesome. You'd have to buy protective puts on each individual stock, which could be getting expensive because you have to pay premium for every contract you take. Okay, and so this is an example here of having purchased a put and purchased shares. So combined, you're going to stay in a profitable situation. If you just purchase the puts or you just purchase the shares of stock, you're going to have returns moving in two different directions, because if the stock price moves up, your share purchases will make a profit, but your put contract will not be profitable. So, whenever you hedge your position, you have to give back some of your potential profits to maintain the hedge. Okay, so let's just look at some other option terminology. So price of a stock is S. Exercise price of an option is E. So what we call in the money, so we have in the money and out of the money. There's also at the money. So if the stock price is greater than the exercise price for a call contract, it's in the money, but a put contract would be out of the money. Now, if the stock price is lower than the exercise price, that's going to be an inverse situation. So stock price lower than the exercise price For a call contract, that would be out of the money. But a put contract, that would be in the money if the stock price is lower than the exercise price. So it's the inverse of what we talked about earlier when the stock price is greater. So again, for put contracts, you want the stock price to be lower than the exercise price. But for call contracts, you want the stock price to be greater than the exercise price to be considered in the money. Now, if the stock price is at the exercise price, we call that at the money. So there's no intrinsic value. So speaking of intrinsic value, so in the previous slide, we're talking about what stocks are in the money, out of the money, at the money. So intrinsic value is when there is some sort of value in your position. So this is realized when you immediately exercise, which means you are going to engage the contract, buy or sell your shares at the strike price, and then realize your gain. So an option, for the maximum intrinsic value of an option, that would be the stock price minus the exercise price, or zero. So you don't have, there's no negative intrinsic value. So if the stock price is 25 and the exercise price is 15, then the intrinsic value is 10. But if the stock price was 20 and the exercise price is 30, then there's no intrinsic value. You don't say negative 10. On the put contract, if the exercise price minus the stock price would be the intrinsic value. So if the exercise price is 15 and the stock price is 10, then the intrinsic value is 5 or 0. So there are no negatives. So even if, say, the exercise price was 20 and the stock price was 30, you wouldn't say negative 10. You would just say 0. So the intrinsic value is really basically how much value is in the contract, looking just strictly at the stock price and the exercise price. Now, prior to the maturity, option premium, prior to the option's maturity, the option's premium exceeds the intrinsic value. Now, because why is that always the case? The premium exceeds the intrinsic value is because the premium includes the intrinsic value in the premium. So the premium has what we call time value. So the time value is going to be added to the intrinsic value to get the total value of the option premium or the option price. So in that respect, the prior to maturity, the option premium is always going to be bigger than the intrinsic value because of this time value. And time values, you can look at that it depends on your time frame. If you have 6 months before the option expires, there's a lot of opportunity there. So the time value is going to be greater. If you have an option contract that's going to expire in 5 minutes, there's going to be almost no time value. So time value, the way to measure time value, we just say the option price minus the intrinsic value, and that's the time value. So the two things that make a premium, there's just two elements that make a premium: intrinsic value and time value. So intrinsic value is very easy to calculate. We saw the formulas up above here: stock price and exercise minus exercise price, or exercise price minus stock price, depending on the call or put, and that's going to give you the intrinsic value. So if you want to know the time value, just subtract the option price or premium from the intrinsic value and you have your time value. And those are the two elements that make up the price of buying or selling an option. So if you have an option contract, should you exercise it early? So prior to the contract maturing and ending, if you're the owner of the contract, you're going to receive the intrinsic value, not the time value. So, and if the intrinsic value is great enough, that might be worth it to do that. But you have to look at all your options, all your value positions in the contract prior to that. Now, investors with the call option are better off selling the option and buying the stock. So if you look at, you sell the option to somebody else, you're going to collect the full premium. which means the time value and the intrinsic value. So if you just exercise prior to maturity, you're going to just get the intrinsic value, but not the time value. But if you sell the option to somebody else, you get both the intrinsic value and the premium. And then you can just turn around and buy the stock. So that might be a better alternative. So investors with a put option that are deep in the money should probably exercise early, as it's not easy. You don't want to trade the put contract and buy a short sell position. So in this case, with a put contract, if you're well in the money, then you should just exercise it early. So that way you can invest the payment you receive and earn the return on the option contract. So, but in Excel, I'll do these different exercise, expire, or trade the contract to show you how the value of those three positions can change. Now there are some price boundaries. So at expiration, options, they have no time premium when they expire. So there's only intrinsic value at the expiration. So options not exercised expire and have no value. So if you don't exercise an option, it's going to have no value upon the expiration. So why would you not exercise an option? Well, if exercising the option is going to lead to a trading loss, then you're better off letting the option expire. So investors only exercise an option if it's in the money. So basically, if your option contract at approaching expiration is, at or out of the money, you wouldn't exercise it. You'd let it expire. A put strike price is its maximum intrinsic value. So with a put contract, the strike price, which is the exercise price, is the most money that you can make. But the call maximum is the price of the underlying stock. So if you buy a call contract, you have unlimited profits that you can make because there's no stopping how high the stock price can go. But with a put contract, the stock price can only go to zero. So the maximum you can make is the strike price is the maximum you can make. Basically, if you buy a put contract with a strike of $20 a share, the most money you can make per share is $20 per share, because once it reaches zero, there's no place for it to go. So if you look at here are the boundaries of the call prices and the put prices. So you can see that looking at these two charts that in buying these contracts, you have that unlimited amount of gain you can get from a call contract, but there's a limited amount of gain you can get from a put contract. Just because once you get to zero on the put contract, that is the most that you can make. Okay, let's talk about the Black-Scholes model for valuation. So this is, when we talk about valuation, we're talking about what's the value of the options contract. So, and we're talking about, we're valuing a call contract with a non-dividend paying stock. So here's the basic mathematical formula that they came up with for the Black-Scholes model. Don't worry, you won't have to calculate this for homework or on an exam, but this is just a mathematical model that they came up to help understand or calculate the value of an option. So, so Black-Scholes valuation can be used for call options. The put call parity will show a relationship between the put and call price. So you can kind of use the value of the call to help derive the value of the put option. Okay, so now basically what the Black-Scholes model is trying to put variables on the factors that affect the price of the contract. When I say price of the contract, I'm talking about the premium. So for a call contract, you're going to have the stock price, the exercise price, time to maturity, stock volatility, interest rates, and cash dividends are all going to be variables in both put and call contracts. Some of these variables will add to the price of a contract. Some will take away. So it depends on what the position is on the contract. But you could see, let's take a call contract. The higher the stock price, the higher the stock price goes, the more valuable your call contract is going to be. Say we have a exercise price at 20, if the stock price goes to 30, 40, 50, the more valuable or more premium that the call contract is going to demand. So the exercise price, depending on where that's set, is also going to add value. So if you had, say the stock price is at 40, you have two different contracts. One has an exercise price at 20 and one has an exercise price at 30. The contract with the exercise price at 20 will have much more premium because you get the right to buy it at 20, not 30. Time to maturity, contracts that are for longer periods of time will have higher premium. The stock volatility, contracts based on stocks that are very volatile will also have higher probability of reaching the price changing significantly. So that's going to be built into the premium. So if you have a very slow moving stock that's not very volatile, there's going to be a low amount of the premium associated to the volatility. But very volatile stocks, that's why when stocks start to become more volatile, you'll see the option prices, premiums go up quickly. Interest rates will also affect options, not greatly, but they'll have an effect to change on interest rates. And if options are paying cash dividends, that's going to also change the value because then you can convert your option into stock and collect the dividend. So these are all things that are going to factor into the value of an option contract. And when I say value, I'm specifically talking about the cost of the premium. Okay. So hedging ratios. So what we talked about earlier, options can be used to hedge or control the riskiness of common stocks. So if you own stock, you can, as a writer, you can write a call contract on stock that you own, and that can help you mitigate some of the risks. Now, what we call a hedge ratio or delta indicates a change in the price of an option for a dollar change in the stock price. So for call options, it would be N to the D to 1, and for put options, it would be N to D to the 1 minus 1. So, okay. So what does this mean? What do options mean to investors? Now, options offer, you can modify your risk and return, which means that you can also have a leverage. So if you were to buy, for example, if you were to buy 1,000 shares of stock at $10 a share, you'd pay $10,000 to get that position. However, you might be able to get, one option contract's worth 100 shares. So you could buy 10 option contracts would be the value of 1,000 shares, but those option contracts could be priced not at $10 per share, but they could be priced at 50 cents a share. So for $500, you can get a position equal to $10,000. So you only have to put down a small amount of principal, and that's the leverage we're talking about. Now, remember we talked about systematic and non-systematic. So these distributions are non-systematic, which can be attractive to investors. So you're not really worried about the stocks and their systematic risks because they can run counter to that. So becoming increasingly valued for the ability to expand a certain set of outcomes and greatly increase the amount of returns or limit the amount of losses. So options is just another tool for flexibility in your portfolio, depending on how you want to engage it. But be warned, because options expire, you're constantly having to renew your option strategies. So if you wanted to have your portfolio continuously hedged with options, that's going to be expensive because once those options expire, you're going to have to rebuy those hedges. So at a certain point in time, the amount of money you spend to hedge your portfolio may outweigh the losses your portfolio may take if the stock prices go down. So that's why generally people only hedge your portfolios when certain risks are looming more substantially in particular periods of time, not continuously to hedge your position. Now, stock index options, there are options on the stock indexes like the S&P 500, the NASDAQ, the Dow. So this allows you to hedge general movements of the market. So if you're really bullish on stocks, you can buy calls or write puts. And if you're bearish on the stock market, you can buy puts or write calls. And this can help, give you the overall exposure to the market, but with a with a leveraged position. So upon, a maturity, you can get a cash settlement of your position if you're in the money, hopefully. So it's just a way if you don't really want to own any stock, but you still want to participate in the change in the stock market. So say for example, the stock market went down 30% and you feel like it's going to go back up quickly, you could leverage your exposure and make much more of a return by getting option contracts on one of the major indexes. So if the stock market reverses and increases back to where it was, you can easily pick up those gains. Now, of course, if you have these stock index options, you can, like I was describing before, you can use them for speculation. You can use it to hedge your portfolio, to guard against risks. So it just depends on, how well diversified your portfolio is to match the index that you want to buy to cover your positions. So this is always difficult to exactly match unless your portfolio is the S&P 500 index, and you can easily match that with buying, put or call contracts on that index. And typically the average investor is not going to bother with hedging their positions on their stock portfolios. If you're long term, you don't really have to worry about hedging because long term, your stock's prices will continually go up in longer term periods. We're talking 5, 10, 15 years. So if you're a long-term investor for retirement, you really don't need to worry about hedge positions. But if you're a speculative day trader or speculative investor, or a hedge fund manager who's looking to beat the markets, then these option contracts might be something useful to use. Okay, so that's the end of Chapter 9, Options. I'm going to make a separate video where I'm going to review some spreadsheets to show you the mathematics and some of the concepts in calculating return with options in more of a spreadsheet format. Okay, thank you for your time.